Andre, the Fed cut their interest rate last meeting and mortgage rates came down. I thought they'd continue plummeting, so I waited to buy. Why are they heading up? Welcome to Dre's Take. Hey folks, last month we witnessed the Federal Reserve cut their key benchmark interest rate for the first time since 2020. In anticipation of that historic rate cut, mortgage rates fell about 1.5%, bottoming out around 6.1% or so. Many would-be buyers sat on the fence thinking, well, it's probably just going to continue dropping. But for the past 2 weeks now, we've witnessed interest rates rise and are now sitting back around 6.4%. How, Andre? Why, Andre? Hold on, I've got some answers for you. There are a few reasons why mortgage rates have increased over the past couple weeks, but it's incredibly important to note that Fed funds rate and mortgage rates are not the same thing. Mortgage rates are not directly impacted by changes in the Fed funds rate. However, they are indirectly impacted by Fed funds rate changes as those changes work their way through the economy. The main instruments that are used to track mortgages or paired with mortgage rates are bonds, and in particular the 10-year Treasury note or the 10-year Treasury bond. Activity in these markets dictate what happens with mortgage rates, and it's not always on par with whatever the Federal Reserve is doing with their Fed funds rate. In this current scenario, investors were expecting the Federal Reserve to continue to aggressively cut rates into the future and at a faster pace. They jumped the gun, priced in that assumption early, and we've seen the rates tumble. Well, in light of new robust jobs data, there's been a cause for pause. Many speculating that the Fed will now reduce rates in slower chunks and at a more spread out pattern or pace. Instead of 50 basis point drops meeting after meeting, it's looking more like 0.25% drops and maybe a couple of months where they just pause and hold tight and see how things work through the economy. Which makes sense since inflation does seem to be tamed and the job market is still robust. Unemployment relatively low, new jobs added, still doing quite well. That means there are people earning money and that money will be spent through the economy. What the Fed doesn't want to do is rush to reduce rates and spur even more economic activity and heat the market up again or heat the economy up again, causing some massive inflation again. It's the last thing they want. We'll be right back to where we were a year ago. They can taper off this rate reduction at a slower pace than would be needed if the economy was falling apart at the seams. Anyway, all of this has congealed to create a sell-off in the 10-year Treasury note bond market, which means as they sell off, prices come down, yields are inverted to price, meaning that the yield on the 10-year Treasury note has increased. And following standard protocol or traditional logic, 200 basis points or so above whatever the 10-year T-note is, it's possible we could see rates rise up to the 7% range again, as many investors believe the 10-year Treasury note may actually hit a 5% yield sometime soon. I think that's sort of a worst-case scenario, and the National Association of Realtors chief economist Lawrence Yun, looking at the brighter side of things, expects 6.5% to be the norm for the end of the year, and then sometime in 2025, rates to come down to the high fives, maybe mid fives if we're lucky. But he also went on to say that he believes the days of 3 or 4% interest rates for mortgages are far and gone, and we'll probably not see those again within our lifetime, or at least within his lifetime. He's a little older than me. At the end of the day, there is no crystal ball, and even the experts are relegated to mere educated speculation, but nonetheless, speculation. Time will ultimately tell. I also want to add that I think the market is a little spooked by the current election cycle. And once we get through this and people settle down and we've got an idea of what the economic agenda is going to look like for the next 4 years, that's when the markets will be able to kind of settle and all this volatility may start to ease. I think we'll have a much better picture of where rates are going to be for a while and much more stability with rates come 2025 once the new president takes office, whether that's Kamala or Donald. The moral of the story here is don't try to time the market. If you need that space right now, make that move. If you need to upsize or downsize from your current home, make that move. Do what's best for you and your life situation or your family's life situation, not what you think the market's going to do 3 months from now or a year from now. Real estate is a long-term game. And if I can help you in any way play that long-term game, I'm always happy to do so. Feel free to reach out. Until next week, that's Dre's Take. All right, y'all. Take care.